If I handed you $1,000 today, could you confidently turn it into $2,000 within 2 months without gambling, luck, or anything illegal? For many people, that question is difficult to answer, not because they are lazy or unintelligent, but because most people were never taught how money truly works. We were taught how to read, write, pass exams, and build careers, but very few people were taught how to manage, grow, and multiply the money they spend their lives working to earn. For many, the financial cycle is simple: earn, spend, repeat, year after year, until they look back and wonder where all their money went. But money was never designed to simply pass through your hands. It was designed to work for you. The wealthy see money differently. They don't only see it as something to spend, they see it as a tool, a seed, and an employee that never sleeps. Every dollar has the potential to create more value if it is given the opportunity. The difference between people who struggle financially and those who build wealth is not always intelligence or hard work. Millions of people work extremely hard every day. The difference is understanding the rules of money. Every dollar you receive has 3 possible destinations. You can spend it, you can save it, or you can invest it. Spending gives you something today, but once that money is gone, its ability to grow disappears. Saving is important because it builds discipline, prepares you for emergencies, and gives you security. But saving alone has a hidden weakness. If your money grows slower than rising prices, your purchasing power slowly decreases. That is where investing changes everything. Investing means giving your money a job. Instead of letting it disappear, you put it into something that can produce more money over time. A small amount invested wisely can grow because money has something powerful on its side: time. $1 today is worth more than $1 tomorrow because today's dollar has the opportunity to grow. The earlier your money starts working, the more time it has to multiply. This is called the time value of money. Time is the soil. Money is the seed. Without time, even the best seed struggles to grow. But there is another force that affects every dollar you own: inflation. Inflation is the silent force that reduces your money's buying power over time. $100 kept untouched for decades may still be $100, but it may no longer buy what it once could. Food becomes more expensive. Homes become more expensive. Services become more expensive. Your money doesn't disappear, but its power slowly weakens. That is why simply saving money is not enough for long-term wealth. Your money needs to grow faster than inflation to protect and increase your future. The goal of wealth is not just having more money, it is creating freedom. And the first step toward that freedom is learning how money works, because once you understand the rules, you can begin making decisions that allow your money to work for you instead of spending your entire life working only for money. That understanding naturally leads to an important question. If saving alone isn't enough to build wealth, where should your money actually go? The answer begins with understanding how banks work. Many people think of a bank as a giant vault where their money simply sits waiting for them. But that isn't how banking works. A bank is a business. When you deposit money, the bank doesn't lock it away in a box with your name on it. It uses those deposits to lend money to individuals and businesses, earning interest from borrowers while paying you a smaller amount on your savings. The difference, known as the spread, is one of the ways banks make money. Banks play a vital role in the economy by helping people buy homes, grow businesses, and access opportunities. But understanding how they operate should lead you to an important question. If banks use money to make more money, why shouldn't I learn to do the same? That question introduces one of the most powerful concepts in finance: compound interest. Compound interest allows your money to earn returns, and then those returns begin earning returns of their own. It's like a snowball rolling downhill. It starts small, but as time passes, it grows larger and gains momentum. Imagine investing $1,000 at a 10% annual return. After 1 year, you have $1,100. In the second year, you're no longer earning 10% on $1,000. You earn it on $1,100. Your money begins making money, and that new money joins the workforce. This is why time is an investor's greatest advantage. Someone who starts investing at 25 can end up with far more wealth than someone who waits until 45, even if the second person invests more each month. The difference isn't just the amount invested, it's the extra years that compound interest has to work. That's why people say, the best time to plant a tree was 20 years ago. The second best time is today. The same is true with investing. Many people believe they need thousands of dollars before they can begin. In reality, wealth is usually built through small, consistent decisions over many years. Investing $20, $50, or $100 regularly can become surprisingly powerful because of time and consistency. But compound interest has another side. The same force that can build wealth can also increase debt. High-interest loans and credit card balances grow over time, causing your money to work against you instead of for you. This is one of the biggest differences between financial success and financial struggle. Financially successful people place their money where it can multiply. Financially struggling people often see their money disappear into debt or purchases that provide only temporary satisfaction. The goal isn't simply to earn more money. It's to direct your money toward assets that grow in value instead of expenses that constantly drain it. Once you understand that principle, the next question naturally follows. Where should you put your money so it can grow? That's where investing truly begins, and one of the greatest wealth-building tools ever created is the stock market. For many people, the stock market feels intimidating. They picture confusing charts, flashing numbers, and experts making impossible predictions. But at its core, investing is much simpler than that. When you buy a stock, you're buying a small ownership stake in a real company. You're investing in a business because you believe it will continue creating value over time. Successful investing isn't about finding the next company that will make you rich overnight. That's speculation. Real investing is built on patience, consistency, and allowing time to do the heavy lifting. One of the simplest ways to invest is through an index fund. Instead of betting on a single company, an index fund lets you own shares in hundreds or even thousands of companies at once. This reduces risk through diversification, meaning if one company struggles, others can continue growing. Markets have always experienced ups and downs. Great companies rise and fall. Industries change, and economies evolve. That's why long-term investors focus on owning a broad collection of businesses instead of trying to predict the next big winner. The biggest challenge in investing isn't understanding numbers, it's controlling emotions. When markets rise, people often become overconfident and buy at high prices. When markets fall, fear causes many to sell at the worst possible time. Successful investing isn't a test of intelligence. It's a test of discipline. One strategy that helps remove emotion is dollar cost averaging. Instead of trying to guess the perfect time to invest, you invest a fixed amount regularly, every month or every paycheck. When prices are low, you buy more shares. When prices are high, you buy fewer. Over time, this builds wealth steadily without relying on perfect timing. Wealth is rarely created by one brilliant investment. It's built through small, consistent actions repeated over many years. But should you invest everything in stocks? Not necessarily. Life is unpredictable, and sometimes you'll need access to your money before the market has time to recover. That's why many investors balance growth with stability. This is where bonds come in. When you buy a stock, you become an owner. When you buy a bond, you're lending money to a government or company in exchange for interest. Stocks generally offer higher long-term growth, but come with greater ups and downs. Bonds usually provide more stability, though with lower returns. Think of stocks as the faster vehicle that can take you further, but on a bumpier road. Bonds are the steadier vehicle that offers a smoother ride. The right mix depends on your goals, age, and how much risk you're comfortable taking. Younger investors often focus more on growth because they have time to recover from market declines, while those nearing retirement may prioritize protecting what they've built. This balance is called asset allocation, and it's one of the most important decisions an investor makes. A portfolio focused only on growth can be volatile, while one focused only on safety may not grow enough to build long-term wealth. The goal is balance, growing your money while protecting it through different seasons of life. But even the best investment strategy can fail if emotions take control. Fear, greed, and panic have caused countless people to make costly decisions at exactly the wrong time. In the end, your greatest financial challenge isn't choosing the perfect investment. It's learning to make wise decisions when emotions are trying to do the thinking for you. Money is as much a psychological game as it is a mathematical one. You can understand investing, compound interest, and diversification, but if fear, greed, impatience, or excitement drives your decisions, knowledge alone won't protect you. This is why many people fail financially despite having good information. They don't fail because they don't know what to do. They fail because they don't stick to the plan. A common mistake is buying investments when everyone is optimistic and selling when fear takes over. When markets rise, people rush in. When markets fall, many panic and sell, turning temporary losses into permanent ones. Successful investors understand that uncertainty is part of the journey. They don't expect the market to feel comfortable all the time. Instead, they stay patient and trust the long-term process, much like a farmer who plants seeds and allows time to produce the harvest. But investing isn't the only key to financial success. Before building wealth, you need a strong financial foundation, and that includes understanding debt. Debt itself isn't good or bad. It depends on how it's used. Good debt helps create future value, such as borrowing to start a business or pay for an education that increases your earning potential. Bad debt is used to buy things that quickly lose value or provide only temporary satisfaction, like financing expensive luxury items or carrying high-interest credit card balances. Every time you borrow, you're making a promise with your future income. If too much of tomorrow's money is committed to yesterday's purchases, you limit your future opportunities. High-interest debt is especially dangerous because it compounds against you. Instead of your money growing, your debt grows, making it harder to move forward. That's why paying off expensive debt is often one of the best financial decisions you can make. It frees up your income, gives you more choices, and puts you back in control of your financial future. Another important part of personal finance is credit. A credit score is simply your financial reputation. It reflects how responsibly you've managed borrowed money over time. Paying bills on time, avoiding excessive debt, and borrowing wisely can improve your score. A strong credit score can save you thousands by helping you qualify for lower interest rates on loans. Even a small difference in interest rates can add up to significant savings over many years. Remember, just because a lender approves you for a loan doesn't mean you can truly afford it. Their decision is based on their risk. Yours should be based on your future goals. Financial freedom isn't about buying everything you want today. It's about protecting your ability to make better choices tomorrow. And there's one more financial reality everyone must understand: taxes. No matter how much you earn, taxes affect how much of your money you actually keep. Building wealth isn't just about increasing your income, it's also about managing it wisely so you can keep more of what you earn over the long term. That's why understanding taxes is an important part of financial success. Taxes affect everyone who earns, spends, invests, or owns property. Rather than seeing them only as money taken away, it's helpful to view them as part of participating in an economy that funds public services and infrastructure. The key isn't avoiding taxes illegally, it's understanding the rules. There's a big difference between tax evasion, which is illegal, and tax avoidance, which means legally using available strategies to reduce your tax burden. Financially successful people know that keeping more of what they earn is just as important as increasing their income. Many governments also encourage saving through retirement accounts and investment incentives. The specific rules vary by country, but the principle remains the same. Learn the opportunities available to you instead of paying more tax than necessary. Another challenge every investor faces is the economic cycle. Recessions, market downturns, and periods of uncertainty are a normal part of history. Businesses slow down, unemployment may rise, and investments can lose value. While these periods can be frightening, they don't last forever. Successful investors understand that economies move in cycles, During times of fear, quality investments may become available at lower prices. While every declining investment isn't a good opportunity, fear alone should never determine your financial decisions. The best way to prepare for uncertainty is with an emergency fund. An emergency fund is money set aside for unexpected expenses such as job loss, medical bills, major repairs, or family emergencies. It provides something incredibly valuable: time. Instead of making panic-driven financial decisions or taking on expensive debt, you gain the freedom to think clearly and respond wisely. Many experts recommend saving several months of essential living expenses, though the right amount depends on your personal situation. The important lesson is simple: prepare before you need preparation. Once you have income, savings, investments, and an emergency fund, the next challenge is managing your money consistently. That's where budgeting comes in. A budget isn't about restricting your life. It's about giving your money a purpose. Without a plan, spending is often driven by emotion. With a plan, you decide where every dollar should go before you spend it. One popular approach is the 50-30-20 rule. 50% for essential needs like housing, food, transportation, and utilities. 30% for wants such as entertainment, hobbies, travel, and dining out. 20% for your future through saving, investing, or paying down debt. The exact percentages can change depending on your circumstances, but the principle remains the same. Every dollar should have a job. Money without direction tends to disappear. Money with direction becomes a powerful tool. As you begin managing your finances intentionally, you realize that money isn't just about buying things, it's about building opportunities, security, and freedom. And that leads to one of the most important ideas in personal finance: understanding the difference between assets and liabilities. Once you grasp that distinction, you'll begin making financial decisions in a completely different way. Instead of asking, "Can I afford this?" begin asking, "Will this help me build wealth, or will it take money away from me?" An asset is something that generates income or increases in value over time. A liability is something that continually costs you money. For example, a luxury car may bring comfort and status, but it usually loses value while creating ongoing expenses such as fuel, insurance, and maintenance. A rental property, on the other hand, can generate income and grow in value, making it a potential asset. Financially successful people focus on acquiring things that continue creating value: businesses, investments, real estate, valuable skills, and knowledge. Over time, these assets work for them, while others spend their income maintaining liabilities. Another key principle is diversification. Putting all your money into one investment creates unnecessary risk. Diversification means spreading your money across different assets, industries, and income sources so your financial future doesn't depend on a single outcome. The goal isn't to eliminate risk. That's impossible. The goal is to manage it wisely. Another silent threat to wealth is fees. Small fees may seem insignificant, but over decades they can reduce your investment returns dramatically because they also reduce the amount of money that can compound over time. Every unnecessary cost matters. Building wealth is important, but protecting it is just as important. That's why insurance plays a vital role. Insurance isn't about expecting bad things to happen. It's about protecting yourself from financial disasters such as serious illness, accidents, property damage, or loss of income. A strong financial plan balances growth with protection. All of these principles become meaningful when you have clear financial goals. Money without purpose is difficult to manage. Whether your goal is buying a home, starting a business, retiring comfortably, or gaining financial freedom, writing down your goals and creating a plan gives every dollar direction. Wealth is rarely built through one life-changing decision. It's built through countless small choices repeated consistently. Saving regularly, investing patiently, avoiding unnecessary debt, continuing to learn, and staying disciplined. Ultimately, finance is about more than numbers. It's about mindset. Two people with the same income can experience completely different financial futures because of the choices they make. Money rewards patience, planning, and consistency while punishing impulsive decisions. The world constantly encourages instant gratification. Buy now, upgrade now, keep up with everyone else. But lasting wealth is usually built by people willing to delay short-term pleasure for long-term freedom. Looking wealthy and being wealthy are not the same. True wealth is having the freedom to make choices, handle emergencies, and control your time. So return to the question we started with. If someone gave you $1,000 today, could you turn it into $2,000 within 2 months? The answer isn't based on luck or finding a perfect investment. It's based on understanding timeless financial principles. Giving your money time to grow, investing wisely, managing risk, avoiding destructive debt, and making consistent decisions that compound over the years. Every dollar saved, every dollar invested, every lesson learned, and every wise habit strengthens your financial future. Remember, money is a tool, use it wisely. Money is a seed, plant it carefully. Money is a worker, give it a job. The greatest financial transformation doesn't begin when you become rich. It begins the moment you start thinking differently and making intentional choices that your future self will thank you for. Thank you for spending these moments with me. If this video changed the way you think about money, imagine what consistent financial education can do over the next few months. Subscribe and turn on notifications so you never miss the lessons ahead. Your future is not determined by where you are today, but by the decisions you begin making from this moment forward. So keep learning, keep growing, keep building. And remember, the greatest investment you will ever make is the investment you make in your own financial education. Thank you for watching, and I'll see you in the next video.